Artificial intelligence has become the heartbeat of the global economy. From Wall Street to Silicon Valley, artificial intelligence is everywhere, rewriting code, creating content, predicting markets, and even generating profits. But with every boom comes a question that makes investors nervous. Is this another bubble? As market valuations for artificial intelligence companies rise, that question has gone from whispered doubt to a full-blown debate. Two of the most influential artificial intelligence chief executive officers have now spoken out, offering drastically different views on where we stand. One says this is just the beginning, the other warns that history may be repeating itself. This is the story of the artificial intelligence bubble anxiety gripping global markets, and what the people building this future actually think about it. Over the past 2 years, artificial intelligence has turned from a technology buzzword into an industrial revolution. OpenAI, Anthropic, Google DeepMind, and hundreds of startups have captured the world's imagination. Chatbots write essays, code entire programs, and summarize medical journals. Corporations have rushed to integrate artificial intelligence into everything, from customer support to logistics to product design. The numbers tell the story best. Since the launch of ChatGPT, global investment in artificial intelligence startups has crossed $200 billion. The Nasdaq Artificial Intelligence Index has more than doubled. The world's most valuable chipmaker, NVIDIA, briefly became a $3 trillion company, worth more than Amazon and Google combined. Every major corporation now calls itself artificial intelligence driven. Every investor presentation includes the words machine learning, and every headline warns about automation, opportunity, or apocalypse. But behind the excitement, a new emotion is spreading: anxiety, because this is not the first time innovation has looked unstoppable. In the late 1990s, another wave of technological optimism swept the world. It was called the dot-com boom. Back then, the internet promised to change everything: communication, shopping, education, and finance. Billions poured into startups with little more than a website and an idea. Companies like Pets.com and Webvan became overnight sensations, and then, almost as quickly, they collapsed. Between 2000 and 2002, the Nasdaq lost 78% of its value, trillions of dollars disappeared, and the word bubble became a permanent scar on technology history. That memory now haunts the artificial intelligence era. Because once again, valuations are soaring, money is pouring in, and business models remain unclear. One of the first to acknowledge this publicly was Sam Altman, the chief executive officer of OpenAI. Altman, whose company triggered the modern artificial intelligence boom, has repeatedly said that while artificial intelligence potential is enormous, the market surrounding it may not be sustainable in the short term. In a recent discussion, Altman admitted, "There is a lot of capital chasing the same opportunity right now. Not everyone will survive. We will see consolidation." He compared the current wave to the early days of the internet, a time when excitement outpaced infrastructure. His warning was subtle but significant: artificial intelligence itself is real, but the gold rush around it could easily spin out of control. According to Altman, the long-term winners will be those who actually build products with lasting utility, not those who simply attach artificial intelligence to their name. He is not the only one saying it. Elon Musk, whose companies such as Tesla and Xi are heavily invested in artificial intelligence, recently voiced similar concerns in his characteristic blunt tone. He called the current valuation levels detached from reality. Musk argued that while artificial intelligence will eventually become as fundamental as electricity, investors are treating it like a lottery ticket today. He warned that too many companies are raising billions without clear revenue models, relying on hype instead of value. In one interview, he said, "We are repeating the same pattern we saw in crypto. Everyone wants to say they are in artificial intelligence, whether they are building it or not." To him, the biggest danger is not the technology but the mania around it, because when capital floods into a sector too fast, it pushes valuations higher than fundamentals can support. And when the music stops, most players do not have a chair left to sit on. However, not everyone agrees. On the other side of this debate stands Jensen Huang, the chief executive officer of NVIDIA, the company powering the artificial intelligence revolution. If Altman and Musk are cautious, Huang is confident. To him, the artificial intelligence boom is not a bubble. It is a platform shift on the scale of the Industrial Revolution. In multiple interviews, he has described artificial intelligence as the new electricity, a general-purpose technology that will touch every industry, every product, and every profession. According to Huang, the market is not overvalued, it is underestimated, because artificial intelligence is not about chatbots or applications, it is about redefining productivity itself. Every company, from a small factory to a global bank, will eventually rely on artificial intelligence infrastructure, and NVIDIA, he argues, is selling the tools of this digital gold rush, the chips and computing systems that make artificial intelligence possible. His logic is simple: if artificial intelligence is the new industrial revolution, then the current spending spree is an investment in the foundation of the next economy. Between these viewpoints, Altman's caution and Huang's confidence, lies the truth that investors are trying to decode. So, is there an artificial intelligence bubble? The price-to-sales ratio for major artificial intelligence companies is now higher than it was for technology firms before the dot-com crash. Startups with little or no revenue are being valued in the billions. Venture capital firms are investing in artificial intelligence at nearly 5 times the rate they did in 2021. Yet, corporate adoption of artificial intelligence remains in its infancy. Most companies experimenting with artificial intelligence tools have not integrated them deeply into operations. And there is still no consensus on how to measure artificial intelligence's impact on productivity or profit. That means markets are betting not on what artificial intelligence is, but on what it might become. There is also the psychological factor. Artificial intelligence has captured not just money but imagination. It promises power, creative, intellectual, and economic. It taps into the human instinct to believe in progress that makes it difficult for investors to stay rational. In finance, this phenomenon is called narrative risk, when a compelling story becomes more powerful than the numbers behind it. And right now, few stories are more compelling than artificial intelligence. The idea that machines can think, create, and make money faster than humans has created a new kind of speculative euphoria, one that crosses industries and continents. Even within the technology world, the divide is clear. Some chief executive officers believe we are in the middle of a technological renaissance, where artificial intelligence will raise productivity, boost innovation, and drive the next 30 years of growth. Others think we are seeing a speculative feedback loop, investors funding startups that use artificial intelligence to pitch investors who fund more startups. In short, a hype cycle. And like all hype cycles, it ends the same way. The market runs out of belief before it runs out of technology. Yet there is an important difference between now and the dot-com era. Back then, the internet was an unproven concept. Today, artificial intelligence is already delivering results. From drug discovery and chip design to fraud detection and logistics, artificial intelligence has proven its real-world value. Major companies are reporting measurable efficiency gains and, in some cases, new revenue streams. In other words, while valuations may be inflated, the technology is not imaginary. That could mean the coming correction, when it arrives, will be painful but not catastrophic. Some analysts describe what is happening as a rational bubble. That is when investors knowingly overpay for assets, not because they believe they are undervalued, but because they believe someone else will pay even more later. It is the greater fool theory, but applied strategically. They are betting that even if artificial intelligence is overhyped, they can ride the wave long enough to profit before the market normalizes. And so far that bet has worked. Artificial intelligence stocks continue to rise, funding rounds are oversubscribed, and even cautious investors feel pressured to join, fearing that staying out could mean missing the next trillion-dollar opportunity. Meanwhile, in Silicon Valley, a quiet consolidation is underway. Dozens of small artificial intelligence startups have already closed or been acquired. Larger players are pulling ahead, especially those with access to capital, computing power, and proprietary data. This is exactly what Altman predicted, the artificial intelligence shakeout. When a gold rush begins, everyone digs. When it ends, only those who own the mines remain. The artificial intelligence industry is heading toward that phase now. For policymakers, the challenge is just beginning. Governments are struggling to keep up with the pace of artificial intelligence growth, both economically and ethically. Should artificial intelligence companies be regulated like technology firms or like infrastructure providers? Should there be limits on how models are trained and what data they use? The answers will shape not only how artificial intelligence develops, but also how resilient the market becomes. Because in the absence of clear regulation, speculation thrives and anxiety grows. In the end, whether or not artificial intelligence is in a bubble depends on how one defines it. If a bubble means overvaluation, yes, parts of the market are inflated. If it means unsustainable hype, yes, the narrative is running ahead of reality. But if a bubble means a future collapse with nothing left behind, the answer may be no. Because unlike the dot-com era, the infrastructure being built today, the chips, the algorithms, the models, will still hold value long after the hype cools. This is not just a digital fad, it is a restructuring of the global economy, and like all major transformations, it will produce both winners and casualties. Altman's caution and Huang's optimism represent two sides of the same truth. Artificial intelligence is too powerful to ignore, and too unpredictable to fully trust. The market may correct, some companies will fail, investors will lose billions, but the long-term story, the shift from human-driven to machine-driven intelligence, is already written. The question now is not whether artificial intelligence will change the world. It is how many bubbles it will burst along the way, because every technological revolution looks like a bubble until it becomes the new normal. And this one, for better or worse, has only just begun.